Hey there, fellow crypto enthusiasts and market observers. We're delighted to welcome you aboard here on Key to Crypto, or KTC, your ultimate hub of everything related to crypto. Feel free to check out our previous videos for all the news and updates on crypto. If you enjoy our content, don't forget to like and subscribe so you won't miss whenever we upload. And comment down your questions or thoughts with our official hashtag KTC or hashtag Future of Finance. For today's video, let's dive into Bitcoin and BlackRock. Bitcoin ETFs, a financial marvel that lets you ride the Bitcoin wave without actually owning the cryptocurrency itself. Think of it as your backstage pass to Bitcoin's electrifying price movements. So, how does it work? When you invest in a Bitcoin ETF, you're essentially snagging shares or units of a fund that's all about Bitcoin. The magic happens behind the scenes as this fund mirrors Bitcoin's performance, giving you a nifty alternative to dive into the crypto game without the hassle of setting up and managing a digital wallet or wrestling with cryptocurrency exchanges. Now, why do folks love Bitcoin ETFs? One word: structure. These babies come with regulation and a track record you can trust. It's like investing in the heart of established financial markets, complete with the perks of liquidity and crystal clear transparency. But here's the twist. Bitcoin ETFs often hold a diversified basket of Bitcoins, not just a single unit. That means you get the bonus of spreading your risk, a bit like having multiple horses in the race. Plus, you can buy and sell shares every day, just like you would with other publicly traded treasures. However, here's the deal. The accessibility of Bitcoin ETFs can be a bit of a puzzle, depending on where you live and the legal maze you're navigating. Before you dive in, make sure to do your homework. Check out those fees, scrutinize the tracking precision, and peek into the closet to see who's guarding your precious ETF assets. Remember, when it comes to crypto investments, knowledge is your best friend. So, whether you're a seasoned investor or just dipping your toes into the Bitcoin waters, stay informed and make those decisions wisely. In the ever-evolving saga of the Securities and Exchange Commission, SEC, versus the coveted Bitcoin ETF, the past decade has seen a slew of rejections. But as the saying goes, if at first you don't succeed, file again. And that's precisely what happened on June 15th when financial juggernaut BlackRock threw its hat into the ring, filing for SEC approval of a game-changing spot Bitcoin ETF. BlackRock's bold move didn't just raise eyebrows, it set off a domino effect. Other financial heavyweights decided it was time to dust off their own Bitcoin ETF applications and give it another shot. It seemed like a watershed moment, but reports suggest the SEC isn't entirely sold on BlackRock's proposal, particularly its surveillance sharing agreement. This agreement was designed to be the watchdog, ensuring that fraud and manipulation wouldn't run rampant. It was meant to keep tabs on trading, clearing activities, and customer identities. However, an anonymous SEC source revealed they found the proposal somewhat lacking in specifics. The SEC, unsurprisingly, remained tight-lipped when Forbes' advisor came knocking for comments. The potential SEC nod for BlackRock's ETF has crypto enthusiasts and investors buzzing with anticipation. Peter Eberly, President and Chief Investment Officer of Castle Funds, which manages 3 private placement funds with Bitcoin exposure, puts it succinctly: it would absolutely end the crypto winter. But why is BlackRock generating this newfound optimism when others have faltered? What's behind the belief that its move has emboldened competitors in this high-stakes crypto arena? Let's unravel the mysteries and dive deeper into this. Hold on to your crypto hats, because the SEC has given the green light to a fair share of Bitcoin ETFs and various crypto exchange-traded funds. But here's the twist. They've mostly played it safe, sticking to funds that either follow cryptocurrency futures or dabble in stocks of companies with a not-so-direct connection to the crypto world. Now, enter the game changers: BlackRock, ARK Investment Management, and Grayscale. They're marching to a different beat, aiming to serve up something special for investors. Their goal? To offer straightforward, hassle-free funds that do one thing and one thing only: track the real-time price of BTC. No futures, no middlemen, just the unadulterated, here-and-now price action of the king of cryptocurrencies. But what's the big deal about spot prices? Think of it this way. In the fast-paced world of crypto, spot prices are your real-time, up-to-the-minute snapshots of an asset's price, right in the here and now. They're not bets on what the price might be in the distant future. They're the cold, hard numbers you see on your screen when you check your crypto portfolio. Spot prices are like the benchmarks of the crypto world. They're the foundation upon which all those fancy derivative contracts and trading strategies are built. It's like checking the current exchange rate between the US dollar and the euro before making that international money move. You want to know what's happening in the present, not guess what might happen tomorrow. So, as these financial powerhouses aim to bring spot prices into the mainstream, it's not just about investment opportunities, it's about bringing transparency, simplicity, and accessibility to the forefront of the crypto game. Get ready for a game changer, folks. BlackRock is stepping into the crypto ring with a proposal that's turning heads and raising eyebrows. So, what makes this time different? Well, the experts tell us that BlackRock has done its homework and designed a fund that's laser-focused on addressing the very concerns that had the SEC rejecting previous applications. One of the key issues on the SEC's radar was the lack of safeguards to prevent exchanges from taking a joyride with customer assets. It's like closing the door on those pesky loopholes that left investors vulnerable. Remember the FTX crypto exchange's dramatic nosedive in late 2022? Founder Sam Bankman-Fried's fall from grace was nothing short of a blockbuster, as he faced multiple counts of fraud and conspiracy to commit money laundering. The SEC accused him of sneakily moving customer funds over to his separate trading firm, Alameda Research, where he allegedly mixed it up and spent it as if it were his own personal piggy bank. But here's where BlackRock's strategy gets intriguing. They seem to have taken a page from the SEC's own playbook, studying the lawsuits against crypto giants like Binance and Coinbase Global. Then, they crafted their own application to show exactly how they plan to steer clear of the pitfalls that tripped up their peers. And if that's not enough drama, just days before BlackRock's big move, the SEC filed lawsuits against none other than Coinbase Global and Binance, two of the crypto world's heavyweight champions. The allegations? Violations of securities laws and allowing US customers to trade on Binance.com despite the SEC's stern ban. So folks, this is crypto drama at its finest, and BlackRock is taking center stage with a plot twist that could rewrite the rules of the game. Before we continue, just a quick reminder, don't forget to hit that like button, subscribe for a regular dose of enlightening content, and ensure those notifications are turned on, so you're always in the loop about our latest videos. Hold off on the champagne, Bitcoin traders, because there's some fine print to unpack in BlackRock's latest move. While it's tempting to break out the bubbly, it's essential to understand that BlackRock isn't aiming for an ETF, but rather permission to run a trust. Now, I know what you're thinking. What's the big difference? Well, here's the scoop. While many in the crypto community might see BlackRock's Spot Bitcoin Trust as a de facto Bitcoin ETF, there are some significant distinctions. Let's take Grayscale Bitcoin Trust, GBTC, as an example. It's a familiar name in the crypto investment world, and it operates as a trust, not an ETF. But here's the kicker. GBTC has often traded at a discount compared to the actual market value of Bitcoin. Just last year, that discount was a whopping 50%. However, when BlackRock made its move, that discount narrowed to about 33%. So, why the discount dance? Well, it's because investors in trusts like GBTC can sell their shares on the open market, but can't swap them directly for the Bitcoin held by the trust. Unlike an ETF, GBTC lacks a redemption mechanism. This means that the number of available shares is limited, and GBTC also charges shareholders a 2% fee or expense ratio. Now, the million-dollar question. Will BlackRock's trust face the same issues? Peter Eberle, our crypto expert, thinks not. He believes BlackRock has already been in cahoots with market makers to set up a secondary market for their trust's shares, creating an arbitrage opportunity. This could potentially avoid those pesky price discounts and premiums that have plagued GBTC. In essence, it's how BlackRock's trust could operate like an ETF and sidestep the price distortions that have haunted Grayscale's trust. But, of course, BlackRock is playing it coy, citing regulatory filing restrictions and keeping us all on the edge of our seats. Tune in to our channel for the latest updates on BlackRock and Bitcoin. That's it for now. If you enjoyed today's content, show your support with a like, leave a comment, and hit that subscribe button. Feel free to share your questions, thoughts, and suggestions in the comments section. Together, let's build a community where curiosity and wisdom are freely exchanged and nurtured. Until next time, and remember, the future of finance is here with Key to Crypto, or KTC.